Hello and Happy New Year to you all. Hope you had a lovely festive period and thank you for listening today. So today we thought we would start by giving an update in terms of what happened in 2025 and tell you what did happen, but I think more importantly that we're going to give a outlook to what we think might happen in 2026. So just going through the slides then. The first slide here looks at equity markets in 2026. And you can see it was broadly a very positive year for markets. As we got off to the beginning of the year in January and February, you can see that purple line really shooting up. That's the Hang Seng, the Chinese stock market in Hong Kong. That performed very strongly in the first quarter of the year. A few reasons for that. One, it was coming from a very low base and valuations in China have been depressed for a very long period of time. So it's kind of a bit of a relief rally. But if you cast your mind back to what happened in the first quarter of last year, DeepSeek came through and there was a big excitement about Chinese technology, particularly the fact that they could do artificial intelligence searching, but at a fraction of the cost compared to other software systems out there. As we roll through the first quarter, the next big event that happened was the tariffs that were announced by Donald Trump in his famous speech. And you can see that the impact that had on all global markets as we went into early April, and it really shook investors' confidence. We were unsure if we were going to have what the trade consequences were going to be, if there was going to be a recession, the inflationary impact that was going to be, and that really knocked equity markets. As we got through April and moved into early May, we started to see a number of the trade deals start to be agreed, and that really started to settle markets. And on top of that, market valuations are a lot cheaper, so it was a good time to be purchasing the market. And you can see basically from the middle of April onwards in May, that equity markets bounced very strongly, and then all major markets delivered positive returns. There's a few markets that are probably worth highlighting the most. Europe in green there, up 20% for the year. You can see it also got off to a very strong start, but finished the year very strongly as well. We've already touched on China, which was up 22% in the year. The FTSE All Share was up 24%, and as we came to the end of the year, the FTSE 100, the UK stock market, was very close to the 10,000 level. And in fact, in early January, we've actually gone through that level. Japan is the yellow line there. Again, it performed weakly in the first few months of the year, but bounced incredibly strongly. In October, a new Prime Minister was announced in Japan and introduced packages that were very pro-business and pro-growth friendly. And you can see how strongly the market performed in October. It then did start to give away and people took profits and the market came away in towards the end of the year. But all in all, a very strong year for equity markets. One of the other key stories around the trade tariffs was the impact that it had on the US dollar. And this really matters because the returns I showed you on the last slide were to a sterling investor. And when we're buying the US stock market, like the S&P, we're buying those companies, but we're also buying the dollar at the same time. So the reason the US market was a little bit weaker than other global markets, so the S&P was only up just under 10% last year, was because the US dollar depreciated by over 9% relative to the to sterling. So a really bad year, and some of the reasons behind that were again linked to tariffs. You know, Donald Trump basically alienated the US versus the rest of the world, and the rest of the world responded by saying, okay, we're going to sell down US assets, whether that be bonds or equities to a certain extent. So it was a tough year for the US dollar. On the flip side, what global central banks have been doing over the last few years is looking to diversify their reserves, and they've been buying precious metals as one of the reasons to do that. So in effect, selling US treasuries and buying precious metals, principally gold. And one of the reasons for that is linked to when Russia invaded the Ukraine and the US and other global economies froze all US treasury assets for Russia to access. So there was a concern from other global economies that something similar could happen to them in the future as well. So they're really looking to diversify their reserves, and hence why gold has been in favour. It is another strong year for gold. This just shows the iShares physical gold ETF, which we buy at Luna. It was up 57% in the year, and we actually started buying gold for client portfolios in January. So it was a very good year and a very good strategy to do that. The other commodity that performed very strongly during the year is silver. You can see silver in this red line was up just under 140% for the year, and it was very strong as we came into the end of the year. Now, silver is a leverage play on gold. It's very similar in characteristics. People buy it for the store of value. But on top of that, silver does have a number of more uses than gold. For example, involved in solar technology and electric vehicles. So it's used as a commodity within materials manufacturing as well. So it's particularly helped to deliver the strong performance. What I would say, though, is the returns that you've seen in a very short period of time are very strong, and we wouldn't be surprised if we saw a correction. However, looking forward, this dynamic about gold being a store of value by central banks is not going away anytime soon. So we can see long-term structural driver for gold. As well as that, the central banks that are buying are price insensitive. They're just selling their US Treasury assets as they mature and buying gold. They're trying to diversify their reserves so that they're not too worried about the price level of gold either. As well as that, it takes a long period of time to get a new gold mine on and create new supply of gold. So structurally looking forward, very optimistic about the outlook on gold and silver, but are mindful that they have performed very well in the short term. What about bond markets in 2025? You can see here that all bond markets that we look at and invest in delivered positive returns during the year. The green line is emerging market debt. That was up 12.9% during the year. Very strong year. Emerging markets had a very good year. I mentioned DeepSeek earlier on, but weakness in the US dollar tends to be a positive for emerging market economies, and that certainly came through last year. As well as that, it's a risk-on trade. Emerging market debt is higher risk and therefore performed very strongly during the year. Strategic bonds, which are more flexible bond funds that can invest in different types of credit and different parts of the credit structure, perform very well as too. You can see they delivered a return of just over 7% and also delivered that return with pretty limited volatility. You can see the drawdowns that happened within the corporate bond and government bond market there, and the strategic bond funds didn't suffer the same sort of setback in August and September that the corporate and government bonds did. That being said, it was a good year for government bonds, a return of 5%, which is pretty much in line with the yield that's on offer from these bonds looking forward. So, a pretty decent return. So if we take a step back, 2025 was a very good year. Equity markets performed very strongly and it broadened out significantly. Emerging markets, Europe and the UK and Japan, principally being some of the strongest stock markets, which has helped Luna portfolios because that's where we're positioned. The US performed well, but was held back by the US dollar. Commodities performed well, principally precious metals, and bond markets performed well too. What about going into this year? And this chart here looks at economic growth across different economies in 2025, but in also 2026. And you can see that the predictions from most economists is that economic growth is going to be broadly similar this year as it was to last year. So the US growing by about 2%, UK and Europe growing by about 1 to 1.5%, and China growing by about 4.5%. So the good news as we go into this year is that most economists anyway are expecting that we're not going to see a recession in most global nations, and we're not going to see a recession in emerging market nations either. So it's a positive in terms of the backdrop for the economy going forward. One of the big drivers to returns this year, what we think is going to happen, is the amount of fiscal stimulus that you're seeing from global governments. So this chart looks at the US. On the right-hand side, it's the level of debt that the US economy has as a proportion of their economy, as a proportion of GDP. It goes back to 1940. And if you're looking at the very beginning of that chart, you can see the impact of World War II. As economies go into war, they don't have as much revenues and they're clearly spending significantly on defence and infrastructure and projects like that. And the US debt increased significantly during that period. We then went through a 60-year debt build down, and debt was gradually reduced from over 100% of GDP to about 40% of GDP. Since the financial crisis, debt's only been going in one direction. You can see the dramatic increase that we've seen as debt as a proportion of the economy. Now, as we look forward, the amount of debt in the US is forecast to continue to increase, as you can see represented by that grey dotted line. But one of the key developments last year was Donald Trump passing the One Big Beautiful Bill Act, which is that purple line. which is effectively tax cuts and tax breaks for the US economy. That's a positive in terms that it should stimulate the US economy as we're coming into this year, but you can see the impact that that has on in debt, and that debt to GDP line is increasing significantly. Just to highlight this a little bit better on the left-hand side, this shows the fiscal deficit. As those bars are going up, it means that the US is spending more than they are bringing in tax receipts. And you can see those bars were already quite elevated, and elevated compared to where we see the economy. When the economy is performing quite strongly, you wouldn't expect the government to be stimulating to the extent that they are. But they've really started to accelerate that. And those purple bars just represent the additional fiscal stimulus which is coming this year. So again, one of the dynamics we mentioned earlier was a concern about US debt and people selling treasuries. There's another reason here is that, you know, at some point the debt levels are going to be unsustainable and people are looking for alternative assets like gold to diversify the reserves. And it's not just the US. So this chart looks at Germany, and another big decision announced last year was the announcement from the German government about increasing the amount of debt and the amount of money that's going to be spent on infrastructure and defence spending in the next few years. And you can see how that starts to ramp up, and it really starts to ramp up from this year. So, and this special fund shows an additional 109 billion euros of defence spending, and it's tripled significantly over the past decade. So it's positive in terms of the amount of money that's going to be spent by European nations. And we mentioned Germany, but this is being done across the whole of Europe. So again, should be pretty supportive for growth as we move into this year. Coming back to the UK, I'm going to first touch on inflation, and I'll talk about the forecast for interest rates. So this chart looks at inflation. I've showed it a few times over the past year or so, and you can see the different components that break down inflation. It goes back to 2022, and you can see inflation increased significantly when Russia invaded the Ukraine. We know the reasons for that. Fuel prices were higher, natural gas prices were higher, and our energy bills were higher. What's happened over the last few years is inflation has gradually been trending down. Last year, inflation ran above target. It ran above target because of the budget. So the big increase in national insurance, that meant that people put their prices up, and that really fed through in terms of inflation into the UK last year. However, as we moved into the final quarter, you saw that inflation starting to turn, and inflation's falling now, and it's just over 3% at the moment. So it's still above the Bank of England target, which is 2% inflation, but it is trending lower. And as we move into this year, we're expecting inflation continue to trend lower. So we're expecting inflation to be averaging more about 2.5% this year, and maybe 2% the year after. And that's what the Office of Budget and Responsibility have said in the budget in November. And there's a nice down arrow highlighting where we're expecting inflation to go. And that's important because it gives the Bank of England breathing room. The Bank of England paused in November from cutting interest rates. They did cut in December, but one of the reasons they paused was because inflation was still stubbornly high. As we see inflation coming down, it gives the Bank of England more manoeuvrability to bring interest rates down. And they already have been. And the key word here is gradual. We expect to see, as we have done over the previous years, maybe one cut a quarter. So we're at 3.75 for interest rates now. Where do we get to? Who knows? But I think 3% feels like the neutral rate for the Bank of England. So around that 3% level will be the new normal for interest rates. If the economy is struggling, you could expect to see interest rates cut more than that. Equally, if inflation becomes an issue again, we could move back to the interest rates that we saw. But we're not, as I said, we're not forecasting that at the moment. So we're expecting 2 or 3 interest rate cuts as we go into this year, and then we'll see how things evolve. That again should be a positive. That should be a positive because that provides stimulus to the economy. If people are getting cheaper lending, it encourages borrowing. Equally, if you're getting less money in your savings, then you're more likely to go out and spend it. So that's the whole purpose behind cutting interest rates. And it's not just the UK that we expect to see this. We're expecting a few more interest rate cuts in the US as well, which again could stimulate the US economy. And in May, the Federal Reserve Governor is actually, Chairman, is actually up for renewal. And we'll wait and see what happens there and who Donald Trump elects. But Donald Trump has been very vocal about his desire for interest rates to be lower as well, because he understands and wants the stimulus coming through and a stronger US economy. Where are we in terms of returns looking forward? So this chart looks at yields that are currently on offer from different types of bonds. You've got government bonds on the left, you've got investment grade corporate bonds in grey, you've got high yield in blue, and you've got emerging market yields in green. I think the first thing to say is all those bars are quite high. So if you're looking at the UK, we're getting a government bond yield for 10 years now of around 4%. If you're willing to take a little bit more risk with UK investment grade bonds, so buying bonds issued by companies like Tesco or Shell, you can get a return of around 5%. If you're willing to take a little bit more risk and buy high yield bonds, you can get a return of 7% or so. So when you think of a bond, you should expect to receive the coupon, which is that yield. You're getting anywhere between 4 and 7% at the moment, and it's pretty flat across the curve. And what that means is that you don't have to take 20 or 30 years bond risk. You can buy shorter dated bonds and still get pretty attractive returns. And that matters because on the right hand side of this chart here, it shows what subsequent return you've got from the current yield. And you can see there that those blue bars, that blue line is where we are today. And we're expecting a return of anywhere between 4 and 8% when you look at history from what bonds have done in the past. And importantly there's no negative years. The negative years happen on the left-hand side when bond yields start low and interest rates go up. As I said, our expectation is interest rates go down. On the left-hand side, it just shows the different components of bonds, bond returns over different time periods, and really highlighting the coupon. The coupon is what matters when you're buying a bond. The yield matters when you're buying a bond because that has historically been the key driver to returns. And that grey bar today is what we'd expect to see going forward. What about equity markets? So this chart looks at different equity markets. It shows the range of price earnings ratio since 1990, which is that grey bar. You've got the average since 1990, which is that green line. You've got the start of 2025 in that purple diamond, and then you've got where we are today in that blue diamond. One of the reasons that equity markets performed so strongly last year is because they re-rated and price earnings ratios went higher. That's a positive for equity markets, and that's the reason behind some of the strong returns that we got last year. As we start this year, you can see that most markets are still average. The US is the standout market where valuations are a lot more expensive than they have been on average and are towards the upper range of where they have been since 1990. Some of the reasons we know why that is because of the strong earnings driven by technology that's come over the last 5 or so years. And then we've seen that through the strong returns that technology shares have delivered. But these businesses are sitting on high margins and extremely cash generative, as well as the drive to artificial intelligence. So there is a reason why the US is more expensive, and it sort of justifies itself. So what we'd expect going into this year is not really seeing any more re-rating. The re-rating story was last year's story. What's going to drive equity markets this year is, in our view, is going to be earnings. And this chart looks at 2025 earnings and 2026 earnings in green on the left-hand side. And you can see that the expectation is that earnings start to accelerate this year. As I mentioned, you've got the fiscal stimulus and monetary policy stimulus coming through, which should really support. And also, hopefully, we get things being a little bit quiet on the geopolitical front, which should be a positive for global markets as well. What matters in terms of earnings as well is earnings revision ratios, and that's what's demonstrated on this right-hand chart, and it goes back to 2022. You want those lines to be heading higher and earnings revisions to be increased, and that's what we're seeing at the moment, so that has been a positive over the last year. One thing that we always try to highlight is about the purpose of long-term investing. If we had a lot of people calling us worried after the market falls in April because of the concerns that are circulated around tariffs, and we didn't know what the outcome was going to be. We didn't know that trade agreements were going to be sought. We didn't know how things were going to pan out. And sometimes they're the best times to invest when it feels incredibly uncomfortable to do so. But as is demonstrated from this chart, which goes back to 1986, is that corrections are very common. The red dots represents the intra-year decline that you see in any particular year, and the average is 15%. So the average fall in the market on an annual basis is 15%. And that's exactly what we saw last year. If you're looking at that red dot, the market was down 13%, but we've seen the returns that came through and the market performed very strongly. What we'd also highlight as well is those grey bars are actually what happened for the year. And 3/4 of the time, stock markets, this is the FTSE All-Share, deliver positive returns. And that's what's come through here as well. So just to summarise and bring this all together, it was a very strong year across most asset classes in 2025. Equity markets performed very strongly. Commodities, principally precious metals, performed strongly, and bonds delivered decent returns for portfolios. So all in all, it was a very strong year for client portfolios in 2025. The exception to that was the US dollar, as we touched on. The global economy slowed in 2025 because of some of the tariff concerns and the impact that was going to be, but stabilised as trade agreements came through. As we're looking into this year, you've got fiscal stimulus from the US with the One Big Beautiful Bill. You've got fiscal stimulus from Germany and Europe in terms of defence spending and infrastructure spending, which should be a positive for those economies. Inflation has started to fall. It started to fall in the UK, as we've touched on. It's also started to fall in the US, as these tariff agreements are now known as well. So that gives room for central banks to start cutting interest rates. And the key word here is gradual. We'd expect to see a quarterly interest rate cut maybe in the first 6 months of this year, so 2 interest rate cuts, and then potentially another 1 or 2 as we move into the final half of the year. Valuations are more average now and elevated in the US, so we don't expect the returns that we saw last year in this year for equity markets, and earnings are going to be key to delivering those returns. Thank you for listening today. If you do have any questions or you want to go through any of this in further detail, please feel free to contact myself, feel free to contact your Luna representative, and we wish you all the best in 2026. Thank you.